Now let's talk about Home Depot because it's the worst performer in the Dow today. The move lower, just around 6.5%, coming after its disappointing results, projecting revenue growth to be flat in line over the next year. Their CEO, Ted Decker, saying on today's earnings call that, quote, "We expect this to be a year of moderation in demand for home improvement. While we don't love the moderation, you can't fight the tide with spending going back to services, people traveling and whatnot." Very similar to the trends that we've been talking about now, Dave, for quite some time. And there was a massive boom during the pandemic. People were putting a lot of their spending into renovating their homes, into making some of those home improvements. Now they'd rather go out to dinner than do that, it seems like.
Well, largely speaking, you could argue they're done with that, too. I think that's part of what you're seeing in Home Depot. People spent that money. They did update their homes. They were home, after all, for 2 years, stuck at home, and now they want to get out. But looking again, zooming out with Home Depot, this is now the 7th straight quarter that they've seen declining transactions. But what's almost always made up for that is the increase in your average ticket price. So transactions were down for Home Depot 6% in the quarter, but average ticket price was up 5.8%, almost the same number. Really, and the question is, when you look at that number, is that inflation based? Are people spending more because they're buying more things at Home Depot, or is it simply inflation is the only reason they are putting up the number that they are? And that's, I think, the trend that you're seeing. Really, it's inflation keeping them hanging on.
Yeah, it certainly does. It seemed like this. Well, the muted outlooks from Walmart and from Home Depot certainly having an impact on the broader market today. We're looking at losses across the board. The Dow off 625 points. You're looking at the S&P off nearly 2%. The NASDAQ, the worst performer of the three major averages. Let's talk about all this with Tom Hayes, a Great Hill Capital chairman and a managing member. Tom, it's great to have you back here on set. So let's start, first of all, with just the retail portion of it. The earnings that we got out this morning from Walmart and from Home Depot. Some worrisome trends there. What's your takeaway?
Well, I think the lower end consumer at Walmart is running out of their savings. We still have $1.4 trillion of excess savings, but they are running down. They're going now to basics versus discretionary products. They're shifting from discretionary products to services, as you saw. But the silver lining that very few people are talking about is as these people run out of savings, what's happening is they're going back to work. And we saw in the jobs report a post-pandemic record in labor force participation rate of 62.4%, which is great for the Fed because the Fed can get the slowdown two different ways. The slowing in wage gains, they can collapse the economy, which would cause a lot of people to get unemployed, or more people can go back to work and you can get more supply of labor, which creates a ceiling on wages. And I think that's what we're seeing, and I think that's the silver lining. As for Home Depot, actually the entire top line miss was attributable to the collapse in lumber prices year on year. Excluding that, they would have beat on the top line as well. And I think this is the quarter. If you're a CEO, you have an incredible opportunity to manage expectations down and then beat through the back half of the year. So I think a lot of CEOs are doing that. We did see throughout this first quarter earnings period a lot of the word resilience, unexpected resilience of earnings and results. And I think that managing those expectations is the right thing to do. But I do think in terms of the general market, it's time for the bears to curb their enthusiasm. Why? Because markets don't top when managers are in record cash and overweight bonds relative to equities. You know, managers today are the most overweight bonds relative to equities than they were since the pandemic lows and since the great financial crisis lows in 2009, March of 2009. And those are just not the conditions to get a top in the market. But where we are is an 18.5% rally off the October lows, and we're just consolidating in a normally seasonally weak part of the year. The second 2 weeks of February historically is a very weak part of the year. So expect a little bit of consolidation, use it to find some bargains and opportunities, but I wouldn't throw the baby out with the bathwater here.
I'm glad you mentioned the lumber prices down 50% year over year. You're right. That was something that really took a bite out of Home Depot. Don't want to counteract the positive Fed news that you mentioned there, the labor force participation rate, but both Home Depot and Walmart are increasing wages. Doesn't that counteract any good news that the Fed might see?
In the short term. So we've had the benefit of the commodity prices coming down. We've had this lagged overweight owner's equivalent rent, which anyone who looks at the granularity of inflation knows that in May, June, and July, those numbers are going to start to collapse. Why is that? Because new leases, new rents, commercial and residential, are coming down. It's the old leases working on a lagged basis that have a significant weight in the inflation indices that are holding the thing up. So we're seeing this stubbornness narrative persist. I think as we get to May, June, and July, we're going to see it drop like a rock, and people aren't prepared for that. You know, we had a 25% peak to trough correction in the S&P last year, a 35 peak to trough in the NASDAQ last year. That priced in a lot of bad news this year that we're seeing. We're seeing a slowdown in earnings. We're seeing earnings taken down. And that's what the market does. Since 1950, the market bottoms 6 to 9 months before earnings bottom. And that's why we think the October lows are in. And that's why we've been bullish the last few months when we've been on the show. And what we also think is going to be a surprise is, so even if you think earnings are going lower, it's still time to be in the stock market. And now we're going to start to discount 2024. We've just finished 2022 earnings. We're not interested in that. 2024 S&P earnings are still $250, which means today we're trading just slightly below 16 times forward earnings. So
particular sectors you're bullish on before we go?
I think right now for the nervous Nellies, you want to have a little bit of defensiveness, wait for this to come in a little bit. We like Amgen. We want to have some exposure to biotech, okay? Biotech, more deals are going to start to get done. Pharma has tons of cash on their balance sheet. They have to buy the growth. One name we like is Amgen, is trading at 12.5 times forward earnings. They've compounded capital, return on invested capital, over 20% for the last half a decade. And the story that I love is the biosimilars. They've got a drug now that's going to compete with Humira. Humira is a $90,000 a year drug for rheumatoid arthritis. They're producing a biosimilar for $40,500, and they have a slate of another half dozen of those drugs coming out throughout this year. So we like Amgen at this multiple, and we like Centene. It's a health insurer. They do 65% Medicaid, 30% Medicare. That business is growing by 20%, trading at 10 times forward earnings. So these are defensive, safe stocks until the dust clears and we push higher. But with everyone in bonds, maximum pain is that we do push higher, and that's usually what happens when no one expects it. We don't top when everyone's in bonds. We top when everyone's in equities.
I hope everybody's taking notes. That's a lot you just threw at us. The kitchen sink came at us, Tom Hayes. Good to see you. Great Hill Capital.
Thanks for having me.
Always a pleasure, sure. Thanks for being in the studio.